Mr. Secretary, so it was reported this morning that Amazon will soon display a little number next to the price of each product that shows how much the Trump tariffs are adding to the cost of each product.
On Amazon, in this report that Amazon might start listing the additional cost on specific items put in place by the tariffs, the president is clearly angry. White House Press Secretary Caroline Leavitt said she had spoken to him about it this morning.
Phone call between the president and the founder of Amazon, Jeff Bezos. Sources telling CNN that the president at one point wasn't happy earlier today about a report he saw.
President Trump's strict tariffs are the reason behind Amazon's withdrawal from the American supply chain, not competition or regulations. Amazon, which controls 40% of U.S. e-commerce, has been forced to relocate its operations to lower-cost nations as a result of these high import duties. As jobs and capital move elsewhere, this retreat highlights a weakness in Trump's strategy to strengthen American industry. Big businesses are reducing their imports from the U.S., according to reports, including one from Bloomberg, by 20% in 2025 as a result of these measures. E-commerce behemoths like eBay and Alibaba are expected to reduce their U.S. supply chains by 30% by the middle of 2026, experts say, undermining America's position in international trade. The world economy was rocked by President Donald Trump's audacious trade strategy in April 2025. He levied a startling 145% tax on goods from China, the biggest industrial hub in the world, and a 10% tariff on all imports coming into the U.S. This striking maneuver, as explained by global supply chains, were affected by economic warfare, according to analysts. For Amazon, the industry titan that controls 40% of U.S. e-commerce, the levies posed an urgent dilemma. To protect itself from growing expenses, the corporation restructured roughly $13 billion worth of supply chain contracts in only 2 months. The tariffs have a significant impact, raising the cost of commonplace items that Americans depend on, including laptops, smartphones, clothes, and home appliances. According to a Reuters article, the 145% tariff on Chinese imports caused a 25% increase in the import of electronics alone. Amazon, which is renowned for its affordable rates and lightning-fast shipping, had to make a decision: either absorb the losses or transfer them to clients. Neither choice was viable. Amazon quickly rethought its worldwide logistics strategy and cut contracts with suppliers linked to expensive imports in order to save its business model. This was not merely a small change. It signaled a dramatic change in Amazon's business practices. The business, which depends on efficiency, was no longer able to depend on its current shipping routes and supplier network. Rather, it started reallocating resources to get around the crippling tariffs. Billions of contracts were canceled or renegotiated, and new alliances were formed and less impacted by U.S. trade regulations. According to Bloomberg, this reorganization is part of a larger pattern of multinational firms frantically trying to adjust to the volatile trade environment in the United States. Trump's tariffs are far more extensive than previous trade policies. A 25% tariff on Chinese imports was imposed by his administration in 2018, which put pressure on supply chains but gave businesses like Amazon the opportunity to react through supplier agreements or price changes. But the 145% tariff is a game share. It is more than a tax. For many businesses, it's a barrier that makes importing from China practically impossible. Giants like Amazon are compelled to completely revamp their systems, while smaller businesses who cannot afford the expenses run the risk of going bankrupt. The $13 billion restructure that was finished in 2 months demonstrates how disruptive the tariff is. The limitations are highlighted by Amazon's answer of measures that are protectionist. Trump wanted to reduce the competitiveness of imported goods in order to boost American industry. However, the immediate consequences imply otherwise. The tariffs force businesses to search alternatives outside of the U.S. market rather than promoting domestic manufacture. U.S. import volumes decreased by 15% in the first half of 2025, according to a Wall Street Journal estimate, as businesses like Amazon redirected their activities to prevent the financial impact. Amazon is not the only company impacted by this change. It denotes a wider retreat by international companies from trade lines that are centered on the United States. Commerce is already changing as a result of the knock-on impacts. Asia to North America trade corridors are taking the brunt of the redrawing of supply chains that formerly routed commodities through U.S. ports. As part of its $13 billion revamp, Amazon terminated agreements with dozens of vendors and reallocated billions in investments in different sourcing locations while preserving Amazon's financial stability. The long-term viability of U.S. trade infrastructure is called into question by this action, with decreased activity noted throughout key logistics hubs, ports, transportation businesses, and warehouses that depend on Amazon's import volume are currently feeling the strain. The tariffs are justified by Trump's administration as a means of bolstering the U.S. economy. In a recent statement, Treasury Secretary Scott Bessent made the case that the levies put pressure on overseas rivals and provide U.S. negotiators leverage. But economists don't agree. According to a study by the Peterson Institute for International Economics, the tariffs will result in $50 billion in extra costs for U.S. companies each year, with little indication that new manufacturing jobs will be created. The reorganization of Amazon, which is far bringing production on American soil, demonstrates how businesses are completely avoiding the U.S. in order to stay profitable. Customers are beginning to feel the pinch as well. Although Amazon has protected customers from sudden price increases thus far, the higher import expenses are unaffordable. Retail analysts cautioned that if the tariffs are kept in place, prices for items like apparel and electronics may rise by 10% to 20% by the beginning of 2026. These increased expenses might make it harder for a business like Amazon, which serves millions of consumers every day, to compete. Although the $13 billion contract restructuring buys time, it is only a short-term solution to a longer-term issue with trade policy at its core. The stakes in terms of geopolitics are also very high. Although the tariffs are intended to lessen China's economic hegemony, they run the risk of offending a significant trading partner. China, which provides 30% of U.S. imports, is not stagnant. Beijing has already lessened its dependency on the U.S. market by fortifying economic relations with other areas. To make up for losses from the U.S. tariffs, Chinese exporters are reportedly discussing new agreements with partners in Asia and Europe, according to a Financial Times report. This tendency is supported by Amazon's shift away from Chinese suppliers, which further isolates the U.S. from international trade networks. The reorganization of Amazon is only the first step in the future. As it negotiates the tariff environment, experts estimate the corporation will reroute an additional $10 billion in supply chain contracts by the third quarter of 2025. Trade routes from Asia to North America may change as a result of this change, becoming less reliant on U.S. ports. The impact of tariffs will certainly be increased when more e-commerce behemoths like Walmart and Target follow suit. Global trade may be permanently realigned as a result, with the U.S. losing control over important supply networks. A contradiction in Trump's trade policy is also revealed by the tariffs. Despite being created to safeguard American workers, they encourage businesses to make investments abroad. The lack of new employment or manufacturing in the U.S. raises the possibility that protectionism will backfire. Rather from boosting the economy, the approach encourages giants such as Amazon will put survival ahead of American market allegiance. If this keeps up, companies may look for stability in less restricted areas, which could result in a smaller role for the U.S. in international trade. The $13 billion revamp of Amazon is a wake-up call. It demonstrates how swiftly multinational corporations can adjust to changes in policy and how those adjustments might circumvent the U.S. economy. Trade is changing as a result of the tariffs imposed to demonstrate American power. That can make it weaker. If the approach continues, trade analysts predict that the U.S.'s share of international import flow may decline by 20% by the middle of 2026. Amazon's audacious action keeps company afloat, but it's unclear what the wider ramifications will be for the future of the American economy. As Amazon moves its supply chain from American ports to new centers in Mexico, India, and Vietnam, a subtle but significant change is taking place that is changing international trade. As industries and distribution hubs proliferate in these nations, the once bustling ports of Long Beach and Los Angeles are seeing a concerning slowdown, with workers suffering the most. President Trump's tariffs are the driving force behind this change, which goes beyond a simple business shift. It suggests that America's position as a major player in international trade is eroding even more. Amazon is helping underdeveloped countries' economies by making significant foreign investments, but the price is evident. Port cities and their employees in the United States are being abandoned. For many years, Los Angeles and Long Beach were the hubs of U.S. trade, handling millions of containers from Asia every year. These ports were essential to Amazon's capacity to provide American customers with fast and affordable product delivery. However, activity at these centers has drastically decreased in 2025. Industry data, according to Reuters, indicates Los Angeles saw a 22% decrease in container traffic this year as a direct effect of Amazon rerouting goods to circumvent U.S. tariffs. The livelihoods of thousands of people in California's port areas are in jeopardy as the need for dockers, truck drivers, and warehouse workers declines due to fewer ships. In Amazon's North American strategy, Mexico is becoming a new linchpin on the other side of the border. The business has quickly increased its footprint in northern regions like as Tijuana. In Terry, the location of newly emerging distribution hubs. According to a Bloomberg analysis, Amazon's demand for affordable entry points into the U.S. market is expected to fuel a 35% expansion in logistics facilities in Mexico by 2025. In order to avoid the high tariffs on seabound imports from Asia, these centers permit commodities to cross the border by land. Mexico is the perfect location for Amazon's reorganized supply chain because of its close proximity, cheaper labor costs, and advantageous trade agreements. Vietnam and India are also becoming more significant participants in Amazon's global network. Both nations draw billions of dollars in corporate investment because of their low-cost manufacturing and government incentives. According to a World Bank report, businesses such as Amazon are moving their production from China, which is driving Vietnam's export industry's 18% growth in 2024. India's expanding infrastructure and sizable population make it an important supplier of clothing and electronics. These countries are more than short-term substitutes. They are changing the nature of international trade by becoming ingrained in Amazon's supply chain. Vietnam, India, and Mexico all gain economically from this change. Jobs are generated, local economies are strengthened, and these nations are positioned as essential hubs for international trade thanks to new industries and warehouses. For example, the construction, transportation, and retail industries in Mexico have grown as a result of the flood of Amazon facilities. While India's innovation clusters are obtaining contracts for high-value goods, Vietnam's manufacturing expansion is attracting talented workers to urban centers. These changes improve these countries' economic standing and enable them to contend for market share in international marketplaces that were previously controlled by China and the U.S. And on the other hand, the bottleneck at U.S. ports is causing economic misery to spread. Communities in Long Beach and Los Angeles, where tens of thousands of families depend on port-related employment, are struggling with uncertainty. Local companies, including trucking companies and restaurants, are suffering as a result of dock workers and drivers' shortened workdays due to the drop in container traffic. According to a Port of Los Angeles report, for every 10% decline in approximately 5,000 jobs are lost in the area due to container volume. The human cost is clear when workers experience unemployment or lower pay after a 22% fall in 2025. The wider ramifications are equally worrisome. Because its ports serve as entry points to international trade, the U.S. has always had sway over supply chains. That leverage decreases if Amazon and other businesses move their operations overseas. According to a Financial Times article, if current trends continue, the U.S. may lose 10% of its influence in international commerce by 2027. As crucial participants in a new trade order and centers of manufacturing or logistics, Mexico, India, and Vietnam are stepping in to fill the void. This change calls into question America's decades-long dominance of terms in international trade. The limitations of Trump's protectionist policies are further demonstrated by